In other words, there wasn't, no, you're right. He said there's nobody believes it's going to go higher. It represents there wasn't one person in the whole world, that was willing to bid the price one tick higher. Not one. Up to this point, there could be any number of people who were willing to bid it higher. But it got to a certain price level, and there wasn't one person left in the whole world that would bid it higher. This, by the way, is one of the reasons why technical analysis works, is because the market has a memory. This is why technical analysis works. The market has a memory. Because when the market came back down, you formed a swing low, came back up to this high, there were people who made money by selling this high. There's a good chance those same traders are going to come back into the market and do it again. As well as there are people who lost money by buying that high. Because for every trade that was made up to this last price, there was a buyer and a seller. There was a trader on the other end of the trade that bought that high. Now when the market comes back again to the same price level, chances are there will be an imbalance between the buyers and the sellers. Just by the mere fact that the people who made money are going to be willing to trade it again and come into the market maybe with a lot of ferocity. And the traders who lost money by buying that high are probably not going to be willing to do it again. And so what you have is even more of an imbalance that existed the last time. Are you guys with me on this?
I'm waiting for it to break through.
Okay, well that's fine. You can do that. However, no, I'm not going to really get. The most I'm going to do is get into what we're just doing right now, because this is not, this is not a course in technical analysis. I mean, and it doesn't really matter anyway, because you guys are trading off of mathematical formulas, and not doing subjective trading. So, and this would fall into the category of subjective trading. Subjective trading also is the equivalent to like who watches Texas Hold'em tournaments like on TV? Anybody? Come on, give me more of a show of. So you've got categories of development where initially people, when they play Texas Hold'em, you play your cards, and then you get good enough at playing your cards. What you start doing is playing the people, and you get good enough, you get so good that you don't even have to play your cards. You don't have to look at your cards. You just play the person. That's the equivalent to subjective trading. Okay, what you're doing is you're using a process of deductive reasoning to determine who's thinking what and what they're likely to do. Okay. And the only reason I'm giving you all this information and making this point is so that you understand with no uncertain terms that there is a whole category of traders out there, people out there, traders, people who have both the financial and the psychological resources to bid markets up and offer them lower. And what's the point that I'm making? The point that I'm making is that any particular technical methodology that you use to determine a pattern is present that gives you a higher probability of one thing happening over another, until you can get into the minds of the people who actually move prices, you will never know for sure what's going to happen next. The only people that know for sure are the people who are willing to do it. And that's what you got to burn that in your brain. You will never know for sure what's going to happen next, unless you can read the minds of the people who are going to do it. And there are people who will do it. And they do it all the time. That's the only way you end up in a winning trade. Most of the time when you end up in a winning trade is because of what these other dynamic traders are doing. So to convince you that there are people who are willing to do this, if I'm a hedge fund manager and I've got to unload a huge position and the market happens to be sitting right here in relative to this chart pattern, how might I maximize my profits? What might I do? Now remember, I've got to sell. I'm going to be a seller. But what might I do to make sure that I get the best price? What?
Drive it up and sell.
Yeah, drive it up. In other words, I will do the opposite of what I want to do to get a better price. And I will drive it up. But how much risk am I taking by doing that?
Probably not a lot. If you sell it just a little, drive it up, and sell a bunch coming back down.
Well, yeah, I mean, if I drive the price up by taking out these offers and then bidding up taking out it off. In other words, I can look with depending on the kind of software I have, I can find out what depth, the depth of the market, meaning that you know, and I'm not saying these are hard offers because people pull their offers all the time. But I can look at this, I can look at this high and I say, you know what? How much money might it take for me to drive the market from here to just past these highs right here? How many offers do I have to take out to do it?
Just tally it up.
Just tally it up and see if you want to spend the money. Because in essence, how much risk are you actually taking? See, by driving it up, what you're doing is you're increasing the asset value of your portfolio. So in that sense, you're not taking any risk. You're actually making money. If I continue to drive the price up, I am actually making the trades that I made down here winners. Every tick that I drive the price up, I'm making myself a winner on the trades that I made at lower prices. To actually drive a price up because you are making yourself a winner at the prices that, you know, what you bought at lower prices. If, for an example, by me driving this price up, it draws other people into the market, that will help, will it not? Because it creates more of an imbalance. Now, that's the real thing. What I want to do is I want to get more buyers into the market. And the reason why I want to get more buyers into the market is so somebody is there to take the other side of my sell orders. Because that's ultimately what I'm doing here. What I'm doing is I want to sell. So what I'm doing is creating a bigger pool of orders to come into the market till I can sell into so that my sell orders don't drive the price down. And so I will purposefully do the opposite of what I want to do, ultimately, with respect to my position. Now, the reason why I'm selling has nothing to do with this chart pattern. Absolutely nothing to do with the chart pattern itself. I'm just using the chart pattern as a means to maximize my profits. Now, what if I managed to drive it up to resistance? Chances are there's going to be a lot of sell orders coming in that I'm going to have to compete with. That's a risk that I'm taking here. But what if I can drive it a little past that resistance? What I'm going to have is a situation where all the people, the other traders who sold at this level right here, that came into the market because it was approaching this previous high, they're going to put their stops a little bit above the market. Now, what kind of stops are they going to be? They're going to be buy stops. If they sold to get out at a loss, they have to be buyers. If I can drive the market to those buy stops, I have given myself an instant pool of orders to take the other side of my trades and get me out at maximum profits. This is typically what you see in a chart pattern as a false breakout. Because what will end up happening is that as soon as my order hits the market, it's so large, and then because there really weren't that many other traders that were willing to continue to bid the market up, what it'll do is it'll take out all the bids and then drive the price right down. That's called a false breakout. It's being done at different time frames all of the time.